We are live. Hey, folks, this is Tiffany Ingram with eXp Realty, and I have my lender partner joining me, Jason Browning with Academy Mortgage. Jason's going to just take some time to talk to us a little bit about the state of the lending industry from his perspective and what he's been seeing with clients that he's been working with. So I'm going to turn it over to Jason, can give you a brief description of what he does and an introduction, a little bit about himself. Jason, take it away.
Tiffany, thank you so much for having me. Yes, I've been doing this for about 21 years, a little over 21 years in the industry from a residential lending standpoint. And just really love helping folks obtain home ownership. And I feel like something that I'm fairly strong at is structuring the proper financing for them to make sure that the mortgage is working for them as opposed to the other way around. And just making sure that overall home buying experience is an enjoyable one. But yeah, I've been here with Academy for almost 2 years, and from the Dallas-Fort Worth area, so I've been doing this here in my backyard for quite a while.
Awesome, thank you, Jason. So we're not going to delay. We're just going to jump right into it. We've got some questions that we know are plaguing the community right now. I'm getting questions from potential buyers. Is now a good time to buy? What is the state of the market? And as well as you, I am hearing quite a different spin. It just really depends on who you're having the conversation with. Some people are still in the market. Other people, unfortunately, if they are if they've been affected by the essential versus non-essential situation with their job, they may have to wait a little bit longer, but then the lending criteria has changed. So we would like to talk a little bit about that. So let's just jump right into the first question. How has the pandemic plaguing the nation affected your business, whether negatively or positively?
Yeah, so some of the things that we're seeing, the mortgage market in general has been extremely volatile, for the past 3 or 4 or 5 weeks or so, ever since some of the lockdown conversations have been had. So that part of it has caused some, I guess, some angst, so to say. When one day rates are considerably lower, and then within a 24-hour period of time, we can see rates jumping a point, 2 points. Again, the good news about that portion of it, that subsided somewhat. We've kind of had a little bit of a leveling off on that, which is a good thing. What we're really kind of finding out is, folks are less likely to show their homes. They don't want, several people walked in and out of their house. And the other thing is a lot of folks are not wanting to go look at homes that someone's living in with the COVID-19. And then the other thing that is kind of affecting us a little bit from a verification standpoint is the joblessness has taken several people off of the path of trying to find a home at the moment.
Absolutely. I know that you and I have come across some situations where just because there are some stricter guidelines that are now in place, there's just going to be a different criteria that people need to be able to meet in order to purchase in this market today. Buyers that you've worked with, how has it, and you may have answered this, and forgive me if we're reiterating, but how has it affected the buyers that you're working directly with and their ability to secure financing to purchase a home?
What we've done, honestly, there's been some preemptive conversations that you and I've had, and I've had with other clients. So it's going to be certain loans, certain loan types, and certain programs, really. That's the things that have been affected the most. Any kind of a conventional loan right now, anything that's 510 and below is really kind of status quo on that. When you start getting into some of your government backed loans, Fannie Mae, FHA, USDA, and VA, they're seeing a little bit of a tightening of the belt on some of the guidelines and requirements on that. And then we're just having to really kind of overly verify that people are employed. I mean, we're doing verifications of employment pretty regularly on loans that are open that haven't closed just yet. So we're really kind of making sure that our folks that are closed or about to close have not been furloughed or laid off or lost their job in general.
Gosh, and I've even heard stories from realtors where, up into almost the very last, the 9th hour, their clients who had essentially qualified for a loan because the job was now considered non-essential, that the lender would not proceed with the loan. So I mean, I guess there is some concern out there whether or not people, even if they are still gainfully employed, if they will remain gainfully employed.
Well, if they're working and they're getting paid, whether that job is considered essential or not, we're going to look at that pay stub more than anything. They don't have to fall into an essential service necessarily to be paid. I'm working from home, and if someone else is considered to be working from home and getting paid, that's not going to have a negative impact. It's just all about, can we get a verification of employment done, and can we verify that they actually are getting paid, then we should be good to go.
And so, Jason, while I understand that this is a temporary situation, it is where we are today, and everyone's had to be flexible and really just take their businesses day by day. So who is the ideal buyer right now, and what does their credit and what does that buying criteria look like today?
Yeah, so the ideal client right now is someone that's going to have a debt ratio that's less than 50, a credit score around 660 on any kind of a government loan. We can go down a little lower than that on a conventional loan as far as a credit score goes. But again, those debt ratios need to be under 50. It's really going to be someone that's got three to 5% down payment is still in the wheelhouse of being a good buyer for us.
Mm-hmm.
So to make sure that we're communicating frequently, that's going to be a good buyer for us. Making sure that their employment is stable, the income is continuing, and let's make sure we have a conversation before any kind of an offer is made, because it could be something that changes day to day. Some of these rule books that we're writing right now, we're writing them on the fly because this is something that is unforeseen, and we're really just kind of taking it day by day. The good thing about it is we're trying to continue to do good loans, and that's something that Academy is doing extremely well.
Got it. So a lot of folks, depending on their situation, do require down payment assistance. Is down payment assistance still available? And if so, are the requirements the same, or have they too been modified?
Yeah, they're saying that these are still available, and they have tightened the requirements a little bit on the debt ratios and the credit scores, and they too are going back and just really they're not as lenient as they've been. So they're looking at it more from a liquidity standpoint, making sure that our borrowers are going to be able to fit in the box a little bit tighter than they have in the past. A little fewer exceptions, and really just it's all about that ability to repay is what they're looking at.
And so I know that usually those folks who require down payment assistance, they usually have a credit score of around 640. Has that the FICO score, does it now need to be higher than 640 in order to even be considered for down payment assistance?
Yes, it needs to be a 660 at this time.
Okay.
And again, that is for Academy Mortgage. We are seeing other lenders out there that have stopped this altogether, or they're requiring a 680, 700, even tighter debt ratios. So it is a case by case, lender by lender.
Mm-hmm.
But there are very few lenders that are still operating and offering this type of loan, to be honest with you.
Sure. Okay. Awesome. So prolonged unemployment, we know that definitely will affect purchasing power. And from your perspective, how so? How do you see that being a problem just in the financing industry, just overall?
That's a very good question. So I will say the unemployment is going to affect the purchasing power for that individual that is not working. For us, what really is going to change in the market with the prolonged unemployment is just the validity, the volatility in the mortgage rates and programs. Does that prolonged unemployment, does that tighten the screws on liquidity? Does it tighten the screws on some guidelines? Potentially. Does it make rates a little bit more volatile? Potentially. I do feel we're going to be in a recession for a period of time, so the rates, are going to fluctuate as we continue to get good news about COVID-19, and then also some of the opening up of the government and the states. But it is going to be on a kind of a little bit of a roller coaster there. With I do think rates will remain low. It just may not be in a straight line. But that will be the only thing that I think for the folks that are working, it may impact them a little bit for a period of time when if rates are a little bit higher than they were yesterday, the day before, but they will come back down in my opinion. So that's really the only thing I see.
So now this next question is really one that plagues a lot of people, because as you and I both know, student loan debt is really at an all-time high. So what should buyers with student loan debt know about how this debt affects their ability to purchase?
That's a very good question. Now, as we've always had, there's student loans are looked at through a different lens and different types of loan programs. So let's just take conventional lending, Fannie Mae, Freddie Mac, for instance. They'll basically take what's on the credit report, not showing any kind of forbearance or deferment, and they'll take that as the payment. So typically on the credit report, that's going to show a little bit of a lower payment than a fully amortized payment like this is your start date, this is your end date, the debt will be gone. Now, if it is showing forbearance or it is showing deferment, we can do one of two things. We can take a percentage of the overall balance of the student loans and count that as a payment, or we can actually get literature, documentation from the student loans themselves about what the minimum required payment is. If it is on a zero payment due to income-based repayment, then we can use that zero payment. We can actually go off of that data and use that as a payment. Now, if you're switching over to a government loan, they're going to want to know what kind of worst case scenario. This has been a little bit of a shift over the last few years. They used to be more lenient on student loan debt than they are now. They will actually take a worst case scenario of a 1% payment or a fully amortized payment showing an end date on that loan, and they don't allow for a deferment or forbearance on those. They definitely want to hit a payment in the overall debt ratio.
Is that I'm sorry, with the government-backed loans, is that where we're seeing more stricter guidelines with regard to the student loan? Is that where I'm understanding that usually is like a 1% calculation of the total debt?
That is correct.
Okay, awesome. Yeah, it's I had someone mention the other day that they kind of felt like the wind had been taken out of their sails, because while they were getting the higher education, they didn't realize that when they got to this point that it would be detrimental to their ability to purchase a home. Even though everything else is in place, unfortunately, that really kind of tipped them over that percent scale.
No, I think you're absolutely right there. It's been a shift in the thinking from the government loans to the conventional several years ago.
So this is kind of my final question to you, Jason, and I do appreciate you taking the time out to answer these questions. What else can you share with future homeowners, particularly first-time home buyers who, again, haven't been affected as much financially by the current pandemic and are looking to be purchasing maybe sometime in the very near future? What would you leave with them?
Yeah, so most of our business that we're doing now is business as usual. When it comes to whether it be an existing homeowner buying a new home or a first-time home buyer, it's really just about maintaining, taking care of your bills, paying your credit cards, paying your car loans, kind of keeping your credit in order. Just being very mindful of putting money away when you can, just showing that kind of a pattern, and just making sure that what we want to do is once we get them pre-approved, it's just to make sure that we stay in contact. And that's something that my office does about every 2 weeks, is we reach out to our pre-approved borrowers to let them know of any changes that have happened in the guidelines, ask them how the home shopping is going. Just continue to have that open level of communication, that, hey, we're going to go make an offer this weekend. Has anything adjusted? And then we can communicate with them if there has. But usually most of the folks that we have pre-approved, we're above these changes. So we're still just business as usual on that. And really taking advantage of some of these really low interest rates, and that actually is increasing their purchasing power, or allowing them to stay within their budget and buying a more expensive home doing that.
Awesome. Amazing. Well, that's all for today, folks. We do appreciate you tuning in. Jason, again, I want to thank you for taking the time out to just give us some tips and some pointers on what we need to do to stay relevant in the market, and how we go about ensuring that we do have the credentials that we need in order to move forward with a purchase and purchase successfully. So I do again want to thank you. We are signing off.